Joining me, Senior Manager Trading Services at Charles Schwab, alongside Diane King-Hall, our Senior Markets Correspondent. Hey, Scott, give us a quick market thought here. As for all of the drama, the S&P's only down 0.75%. That ain't too bad.
Yeah, that's not too bad. But like you were mentioning a minute ago, it feels bigger than it is. We get carried to the top of this huge mountain today, and then we come down back down. And even though we're really close to where we were, we're down, but not all that much. It feels like a big deal because of the stuff that went on with NVIDIA.
No, you're right. You're totally right. When you rally and fade, it feels a little bit worse than just if you just dropped, Diane. We had our hopes up high this morning. It looked like we were approaching the promised land.
It's true, but we had that economic data that started to kind of pull out, it just threw cold water on the rally that we were seeing. I mean, you had the tech sector still holding up, but things just started to deflate as the day progressed, and then that concern about inflation showing up in that flash PMI report that reared the conversations back to the forefront of what will the Fed do next. And then I just checked the CME Fed Watch tool, and the flip for September rate odds cut is changing. I mean, now it's a little less than a coin toss on either direction on where investors are expecting the Fed to move come September. And before today, the odds were 2/3 of were expecting a cut by September, but now it's questionable.
Meaningful change there. Good stat for sure. Let's talk some earnings here as we look at Intuit and Workday out. Workday is, I think, the most important one here because it kind of sets the tone for cloud for the next couple of weeks when we got companies like Salesforce around the corner and stuff. And it's a little bit of a drop in the aftermarket. It's generally a very reliable business and one that correlates pretty well to the worker. No surprise there. 18% revenue climb on an annual basis to $1.99 billion is ahead of the street's estimate of $1.97. Subscription revenues were up 19%. Professional services, a small portion of their business, but a growing one, up 12% to $175 million. Some of the expenses also rose, though. Product development expense up 9.3%. However, the operating margin did beat the estimate. They hit 25.9%. which was up from 23.5 a year ago. Estimate was for 24.5. So, I mean, it looks pretty good, Workday. So the outlook is something I'm looking for here that maybe, okay, so here we go. Their fiscal year subscription revenue outlook. They did soften it a little bit. Boy, this market is sensitive here. 7.7 to 7.725 billion. I mean, the street was expecting them, or rather they had told earlier, 7.775. So, like, if you're hearing me and you can't tell a difference between those numbers, it's because it's very small. But they're punishing them, Diane.
It's true. And it's, I'm not sure if it was you or Scott who made that comment about how jittery the market is right now. So it's just like a little bit of a cold wind, and now things are just turning over. And like Workday, it doesn't look bad. We are looking for, they talked about more AI integration within their business. They talked about it in their last quarter that they were working through that. Now they've finished the acquisition of Hired Score. So, I mean, the numbers don't look bad. It's when you look at kind of what the expectations were coming into this, but it's a very sensitive market right now.
It's like a teensy tiny, revenue cut to the expectations, Scott, and they're like, taking a bat to the stock right now, down 6%, roughly.
Yeah, but, I'm just going to reiterate what's already been said, right? We are in a hypersensitive market right now. But, the one thing that I do like with Workday, though, is I like that professional services. I like to see that coming up. That's kind of a new thing for them, not new business-wise, but to see these kind of numbers move. And I think that can be promising. Investors and traders, in my opinion, will probably be watching for more of that as time passes, because that can be a really important component to Workday's business overall.
Yeah, true. All right, so it seems like, pretty straightforward business as usual. pretty good stuff with the minor exception of that small tweak lower to the outlook. But, I mean, look, the company still is going to hit $7.73 billion subscription revenue for the 2025 year if they hit the high end. That was just the old low end with the high end at 7.78. So they did shift it down a little bit. And they're getting punished for it, I guess. Intuit, let's talk about that because there's a beat there on the trailing numbers. And stock has been very reliable as well, but it's getting hit too. You really haven't been able to go wrong with Intuit just because of the product suite, so popular between Credit Karma, TurboTax. I mean, the stock's been a beast, Diane, so I don't want to make too much of a little drop here. It's not quite as big a move as Workday, but it is a drop.
As Workday. Yeah, no, I mean, they beat on revenue, 9.88. They're guiding for EPS for the fourth quarter between $1.80 to $1.85 on revenue of between 3.06 to 3.1 billion. I mean, it looks like there's some mixed numbers in terms of guidance. We'll want to hear, you made the point also about AI with regard to both of these companies, how much more that is being kind of accounted for in their business. Intuit talked about it a lot on their last earnings call. I counted more than 30 times they talked about it on their last earnings call. So we want to hear more about what's going on as well with regard to the guidance. But it looks like both of these companies are being punished a little bit in the aftermarket. Would love to hear what they say on their earnings call, and also if this rolls over tomorrow.
Yeah, their outlook is okay. Generally, 16.16 to 16.2 billion. Or their last reading was for 15.9 to 16.1. So it's the opposite of Workday. They shift up the guidance a little bit, at least for the revenue side. And I mean, it looks like a good report from a really good company with a lot of different functioning business models. Their small business and self-employed group revenue were up 18%. That's a pretty key market for them to capture beyond just the retail, tax filer, Scott.
Yeah, 100% agree. And, the other thing about Intuit, it's just a workhorse, right? This thing's been very consistent. We've seen a beat in expectations every quarter for the last year. Probably even goes back further than that, but at least for the last year. The first quarter of the calendar year, it was up by 22.43%. So, and furthermore, just a solid fundamental company by comparison, if you take PE as the fundamental criteria, but you've got PE ratio of these guys. They're at 59.42. The industry ratio is right around 32.2. So just a solid workhorse company. I expect no less. So
they're a little expensive though compared to the group. So maybe if market is in the mood to take profits, which it seems it is, then they're a target. Let's talk some retail here. I think the most fun one this afternoon, frankly, is Deckers, because their brands are doing amazing, and it seems like they are taking the market share away from a few other companies, Under Armour, Nike. We've just seen a struggle bus for a lot of different athletic wear businesses, and then Hoka is just booming. I mean, it's crazy how popular these shoes are. They've been hitting 20% growth for the last couple quarters. It looks like they're going to do that again. Some of the outlook actually is imperfect, but the stock doesn't care. It's rallying anyway. Their earnings outlook, $29.50 to $30 a share. Street was looking for at least 30. Their gross margin, they're saying for the full year, will be about 53.5. The Street was expecting 54.5. So they've got two tiny little misses there on the outlook. But I guess when Hoka's growing 34%, Diane, that's all that matters.
I know, we talked about this before. There's a separation between winners and losers now, especially with these consumer-facing companies. Like, for instance, we looked at VF Corp from the overnight through today, and how they were performing, and we see Hoka everywhere, so it's pretty ubiquitous. They're sneakers, So it looks like that is what investors care about, especially when it comes to Deckers. I haven't seen what the Uggs vertical looks like, but we were expecting to see a little bit of deceleration with Uggs, but that makes sense when you think about the seasonality of that brand in particular. But Hoka continues to, pardon the pun, run its race and run the race well for Deckers.
Yeah, amazing. You got some Hokas yet, Scott Durfey? You going a little hiking shoe?
No, I've got 3 pair of running shoes that are Hokas for sure.
Right.
I love, I love their trail shoes. I've been running in Hokas for like over 7 or 8 years, back when they were just big, ugly, clunky. But the thing about Hoka, or the thing about Decker, is it's also trading pretty expensively, right? It's the PE ratio for them is almost 33. The industry's 16.9. Wow. So again, these things have to eventually. I guess they don't have to. There's no rule that says that this has to happen, but these things tend to kind of even out over time, unless they can maintain the momentum that they've established, which they may do. They're positioned almost pretty readily to do that.
Yeah, pretty great. Growth there. UGG too, still growing double digits as well. 15%.
Yeah, it is.
So
yeah, about 15%. So Hoka and UGG are the leader. Hoka up 34%, as you mentioned, Oliver. So definitely doing well. They even highlighted their DTC on direct-to-consumer sales rose 21%.
Wow.
So they're doing well, whether it's DTC or wholesale.
That's a big deal. People are seeking them out, and going to the site to get them. That's kind of what folks are doing with ONS too for a little, and then they show up in some of these discounter stores. Speaking of discounters, ROST just beat. Earnings came in above expectations. They lifted their outlook for the fiscal year. Shares trying to rally here. Pretty nice little move. Wow, the retail success story this afternoon. Look at that. Both our tech stocks down, both our retailers up. And a pretty clean report. Not huge sales. ROST just kind of clipping along at like 3% comps, which is about what the street was looking for. Street was thinking maybe they would hit 3.4, but 3 seems to be enough, I guess. Sales overall up 8%. So total locations have climbed. They added a few more in the quarter. And it seems like pretty smooth running business as far as discounters go, Scott. People are finding the right price points at these places.
Yeah, and that's what they're looking for, is right price points, and that's what's currently driving discount retail stores like Ross. When we get to, and we know the economic situation that we're in, we start feeling these pinches, and these types of companies start doing much better. Ross Stores, since I've created a theme here, Ross Stores is fairly trading according to PE. They're trading at 22.33, and the industry ratio is 22.40. So they're trading very fairly compared to the rest of the industry there. I think their growth, the fact that we've seen them add stores over the last quarter, that's a positive rather than contract. When we start seeing these things and they're able to maintain them, I think that there can be some momentum built behind that. Maybe we continue to watch for it.
Yeah, well said. Last thought, Diane, real quick.
And it plays into the theme of consumers seeking value. We saw that in TJX numbers. Look, Gail King has even been to Ross stores. So if someone with pockets that can afford somewhere else is going there, that it shows that it's going to hold up well, especially when consumers are making choices on where they're going to spend and finding more bang for the buck there.
Great stuff. Well said. Thank you, team. Scott Durfey, Diane King Hall, nice work.